Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500, a pretty average bear market. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. You can find a link to that down in the description below or the pinned comment. You will get access to this website you see me often using on the YouTube channel, as well as 3 weekly premium videos per week, a newsletter, trading view indicators, a Telegram alerts channel, a chat room, and more. Make sure you check it out. We have that sale running in November. Now, the purpose of this video is to show you what is possible. By comparing to prior bear markets, we are not trying to show you what has to happen or what will happen, but simply we want to show you what could happen. And by understanding the context of what could happen, you can at least prepare for scenarios that you may have otherwise been unprepared for. Normally, when we look at this chart, the first exercise that we do is we cherry pick specific bear markets and compare it to the one that we're currently experiencing. Let me do the same to begin the video, and then I'm going to show you a different way to look at the data. This is the 2022 bear market. It's a series of lower highs and lower lows. It's a structural bear market. It looks like a very structural bear market. We're just simply putting in lower highs and lower lows. One of the things that we might like to do is to compare to bear markets in recent history. Therefore, it might be prudent to compare to one of them to see how similar it looks. This is the financial crisis from 2007 to 2009. The interesting thing is that it looks eerily similar to what we're experiencing today. However, I would put forth the argument that a stochastic downtrend in the S&P 500 is going to look fairly similar to a lot of the prior bear markets, and I think that our eyes can often deceive us into thinking what has to happen, when that's actually not the case. For instance, if we were to pull up a bear market from the 1940s, specifically the one from 1946 to 1949, you could also argue that we're following a similar path so far. And it would also seem like, all right, we could follow this path as well. When you overlay the financial crisis and the bear market that occurred after World War II during a period of high inflation, so far, 2022 looks like it could go in either direction. It is not yet clear what path it will take. And the truth is that the 2022 bear market will simply be the 2022 bear market. It will not follow the exact path of any other bear market that preceded it, and likely any bear market that comes after it. It will be its own bear market. So rather than cherry pick various bear markets to make the case that that is the one we're following, what if we simply look at the worst case scenario based on prior bear markets and the best case scenario based on prior bear markets as a function of time? If we do that, we can pull up what I'm calling here the min and max ROI from the S&P 500's peak. What you'll notice is that if you look at the best case scenario, meaning the drawdown as a function of time wasn't so bad, and compare it to where the minimum was, it looks to me like 2022 so far is simply a pretty average bear market. It is not the best case scenario by any stretch of the imagination, but it's also not the worst case scenario either. For the next few minutes of this video, I'm going to isolate just what's occurring over here, and then we'll talk about the tail end of that in a few minutes. You might wonder, what would constitute the worst bear market? Coincidentally, it's not actually a single bear market that will show you the worst case as a function of time. You might not be that surprised, though, to find out that a large part of the worst case scenario would in fact be the Great Depression from 1929 to 1932. However, the 29 to 32 bear market did not always constitute the worst drawdown as a function of time for that period. For instance, there was a bear market over here early on that as a function of time had a quicker drawdown than in fact the Great Depression did. And if you've been following this channel for a while, I'm sure you'll be quickly aware that is in fact the bear market from 2020, where we went down so quickly that it was a quicker drawdown than any other bear market that we've experienced in the S&P 500 over the last 100 years. However, you can see that once the 2022 bear market was over, we had a V-shaped recovery out of it, and therefore it would no longer be the worst case scenario as a function of time. At that point, the Great Depression took over, and then as you get further out, there were at least one other bear market that had a worse drawdown than the Great Depression for a period of time. However, the reason why the Great Depression was remembered so vividly is because the drawdown kept continuing well after most, but not all, bear markets were over, and it certainly had the worst drawdown out of all the bear markets over the last 100 years. Therefore, I would put forth the thesis here that 2022 so far is in fact a pretty average bear market. It's not the worst case, but it's also not the best case either. And we're sort of just tracking right in the middle of this trend. Now, you might wonder, why is there a spike right here? Why would it spike up? Well, this video is not showing you any path to recovery from these prior bear markets. I will likely show that in a future video where we actually take the min and max of the path out of it. But this is just showing you simply how long was the worst case scenario as a function of time. And the 1929 bear market, the Great Depression, ended after about 1,000 days or so. But the ROI for the worst case scenario then shot up. And the reason it shot up is because we're no longer comparing to the 1929 bear market, because we know that we started an uptrend after that. But we have to go back and look at the next bear market that lasted even longer. And that was the one from 1937 to 1942. And you can see that that bear market actually consisted of part of the worst case scenario for a while, but it did not make up every worst case scenario that the S&P, or that the one from the Great Depression also did not constitute. You can see there's a couple other bear markets in here that remain gray that are something else on this chart. You can see that the one from 1937 to 1942 lasted a lot longer than the Great Depression. However, the reason why it shoots up is because the drawdown from the all-time high wasn't nearly as bad as it was in the Great Depression. The ROI from peak for the one from 1937 to 1942 ended up being about 0.43, meaning the entire market dropped about 57% over 1,848 days. Whereas the Great Depression, we saw a drawdown of about 96% over around 990 days. So that is why you see it spike back up and then the worst case scenario continue on as a function of time. So I hope that makes sense. So for just a few more minutes, I want to just forget about the 1937 bear market, because we know that it did last a lot longer, but the drawdown wasn't nearly as bad. So that's why I think it's at least somewhat useful to really talk about our general channel here as sort of the worst case scenario. And again, you can see that so far 2022 is a pretty average bear market. We can draw the comparisons to the financial crisis, which it looks like consisted of part of the worst case scenario at around the 500-day mark from the major all-time high. We can also compare it to, as I said before, the bear market that came after the World War II, where we ended up not going down that much more, and it ended up being the best case scenario as a function of time. So I want to warn people that, again, the reason we look at these comparisons is not to say what can happen or what will happen, but to show you what could happen so that you can be better prepared for all potential outcomes. If you're not prepared for all potential outcomes, then I think you're doing yourself a disservice. And by looking at historical data, I think you're just going to become better informed as to what could potentially happen, considering that the Federal Reserve, as Powell made it clear yesterday, they're not done hiking interest rates and they still have a long way to go. And they also seem like they are more likely going to go too far than do too little, because they don't want inflation to become entrenched. I would put forth the idea that the bear market will likely continue for a while, and that right now the market is still pricing in changes in monetary policy, and that eventually it'll be pricing in a recession probably sometime in the next year or so. But I think this is an important comparison to make. So again, you look at the channel, the 2022 bear market is more or less right in the middle of this channel in terms of drawdown from the prior all-time high. In a future video, I'll likely also show sort of the path to recovery for the min and max. But one way that we can also visualize that is to just get rid of the min max, throw on all the bear markets on here, and show them out to the next peak. You can see what they look like, right? It looks somewhat. Let me reset the zoom here. It looks somewhat interesting. Another way to look at this is to cherry pick, right? Even if you take a fairly and this is if you look at 2022, right? Even if you take a fairly bad bear market like the financial crisis, yes, there is a major drawdown, but then look what came after it. Even in the .com crash, you can see that yes, it was a pretty major drawdown, but then we still had a fairly nice run after that. So it's all relative. It's all about understanding, when do the things in the economy start to shift. Remember, once the economy looks extremely bad and it feels like it can't get any worse, even though it does get worse, the stock market will likely bottom before then. The stock market usually bottoms during the recession, not after it, not at the end of it. It usually bottoms before unemployment peaks, not after it peaks. The stock market is forward looking. And right now, again, you're seeing changes in monetary policy being priced in. I think next year you're going to see changes in earnings expectations priced in. And we'll continue to follow this to see just how the 2022 bear market follows the worst case scenario for bear markets and the best case scenario for bear markets as a function of time, taking them all the way out until the bear market was over and not showing any paths to recovery in this context. But I just want to make sure that's clear, because the path to recovery, of course, always comes after it. But we're more so interested in this. And this really does show you that as a function of time, we are a good bit of the way into it, but we could easily still have a ways to go. There is a chance that this bear market could last another year. In fact, if the bear market were to last another year, that would get you out, to maybe somewhere way over here. Keep this in mind as we continue to navigate these financial markets. And as I've said before, cash is king in 2022. That it will not always be king. There will come a day where risk assets in general will do well again, but right now the Fed is not on the side of risk assets, and as they say, don't fight the Fed. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. Remember, you have the sale on the premium on Into the Cryptoverse Premium. You can find a link to that in the description below or the pinned comment as well. And you'll get access to this chart. You can play around with it and see what you think of it, and so on and so forth. So make sure you check it out. I'll see you guys next time. Bye.